to talk more on the earnings and the way forward for the company, we have Mr. Venkateswaran, who is the Group President and CFO at Federal Bank. A very good afternoon to you, sir. Thank you so much for joining us on ET Now. And let's further dive into your numbers. If you look at your NIMs for the quarter gone by, if you look at the NIMs number, it has come in much below what the street was anticipating. If you could tell us what exactly is putting pressure on NIMs and what's the way forward coming in for your net interest margin going ahead?
Okay, good afternoon and good afternoon to all the viewers. At a broad level, I would say that it's a very strong quarter in terms of performance. We had the highest ever operating profit, net profit and NII. And also what is important to note is that the ROA has come in at a very healthy 1.36. Now just focusing on one particular aspect, NIMs may not give the full perspective. I will address your question in a minute, but what we should look at is the contribution of all the lines in making sure that we deliver a very healthy ROA, whether it's credit cost, which is at its quite low. I don't expect it to remain at these levels going forward. And fee income has grown at a fantastic rate, even quarter on quarter and year on year, without any one-offs. And the credit growth has been broad-based. So if you look at from an overall perspective, I would say that it's a quarter of a fantastic performance, especially given the market in terms of where the deposit rates are. That's where I'll address your question on NIMs. Now, probably the market was expecting a particular number on NIMs, and we have, of course, delivered a NIMs which is higher than Q1. But what is important to note is if you see, we have grown our deposits at 23% year on year, vis-a-vis advances, which is around 20%. It was a deliberate strategy to bulk up on deposits, grow it, to make sure that we have enough funding to meet the growth opportunities. If we had not taken that incremental deposits of, let's say, about 3,000 odd crore, my impact on NIM would have been higher by another 4 bps. So I would have easily crossed 320. But we felt that it's prudent to make sure we have enough deposits to support the growth, which we continue to foresee in the 18 to 20%. So that's the explanation for the NIM movement, though it may appear to be lesser than what Street expected, but conscious choice of adding deposits at a particular rate, and deposit costs are going up, and there is still a huge scramble for deposits, and in our view, that will continue for some more time.
So this is Vinny joining in the conversation as well. I just want to ask one more thing in terms of NIMs. Then what is the guidance that you would have for Q3 from here going forward, as well as for the second half of the year? What would be the NIMs that you are keeping an internal target for?
Yeah, I think the way we are looking at it currently for Q3, my expectation is we don't want to be lower than where we are currently. And that itself is going to be challenging us, given the way the deposit pricing is in the market. So our objective is to improve from where we are, but at the minimum, make sure we are not going to be lower than where we are currently on the NIMS trajectory. And for the full year, again, it's a combination of several factors, mostly driven by external, in terms of inflation, global uncertainty, crude oil prices. So at this stage, giving a view on Q4, in my view, things are changing so rapidly. This becomes quite difficult to predict, what it will be in Q4. But having said that, we had earlier guided that H2 will be better than H1, and our endeavor will be to make sure we are delivering on that.
Right. So let's talk about your slippages, because in the quarter gone by, you had a slippage of approximately 350 crore rupees. No doubt on a quarter-on-quarter basis, we've seen a substantial decrease in your slippages number. But if you could shed some more light on what actually contributed to the slippages in this quarter, and also if you could tell us about your future anticipation as well. Do you see the run rate of slippages in the similar area of around 350 crore rupees, or do you see further decline going ahead?
I think the slippages came in at the level which we were working towards. And what is important is the recoveries as well, which we had in this quarter. So the net slippage, if you see quarter on quarter, is just hardly anything, just 1 crore if I'm not mistaken. So we have made sure that the recoveries which we had planned for, and there wasn't any bulk recovery which is there in these numbers. These are all small amounts, and the effort put in by the teams on the field to make sure we get the monies collected. So going forward, our view is, of course, to try and work towards a similar slippages number, but that again depends on several parameters. We should also understand that corporate, the NPAs have been virtually zero in the last 5-6 quarters. It's too good to be true. At some stage, you'll start seeing that coming in some way. I'm not saying anything specifically for us, but this is more from an industry perspective. And what we do believe is, that's why I said the credit cost at the last quarter level of 13 bps is too good to be true. It will normalize at some stage.
And sir, what about, you were talking about your loan growth, your deposits, surely that has been quite good this time. So could you talk to us about the sustainability of that going forward? How do you see it shaping up in the next second half of the year?
Yeah, in terms of credit growth, we continue to guide towards the 18 to 20% growth, which we had indicated earlier as well. There is good visibility on that aspect, and given our risk appetite, we are not a bank which will go, we're a moderate risk-taking bank, and we wouldn't go aggressively into products where the margins are very high initially, but then it blows up 12 to 18 months down the line. So it's a very calibrated move in terms of choosing which segments we will grow, and 18 to 20% growth is reasonable to expect, subject to any black swan events. And having said that, like I said in the beginning, it's broad-based. The relatively high-yielding percentage of the book continues to grow much faster. Products like CVC, gold did quite well, 8% quarter on quarter. And credit cards, PL, these are all small bases, so they grow at 15-20% a quarter. That will continue to grow as well. That's on the credit growth outlook.
Right. Let me ask you a question which actually the entire street is waiting for, about the Fed-FINA IPO. By when do you expect to launch the IPO? Do you think it will happen next quarter, the quarter that we are in currently, that's Q3, Q4, or do you see it actually getting further delayed?
Yeah, at this stage, all I can tell you is that the engagement with the regulators is going on. Questions are being answered. The RHP has been filed, and pretty sure that it's at an advanced stage. So I'm pretty sure the board of FedFina will take a call on when to launch it.
Okay, sir. Thank you so much for joining in with us this afternoon on ET Now, giving us an understanding on when we should be expecting the growth, the Fed-FINA IPO as well coming up. But yes, thank you so much, Mr. Venkatraman, for joining in with us this afternoon.